take out. And then, of course, you look at all-time highs after that. We'll see if there's enough in the tank for the market to sustain after a super gap up. 0.6% in the Nifty, 0.4% in the Nifty Bank. Small cap index is up 0.6%. And it's all green, largely all green. Advanced decline right out of the gates, super strong, 1,000 up, about 250 lower. 24,300 is there on the board for now. Mid and small caps did very well yesterday, much better than Nifty and the Bank Nifty. And I think that perhaps is another theme, right? Is the worst over for small and mid caps? People are starting to ask that question, and we'll focus on that as well as we go along. That's the heat map. A bulk of it all in the green, a few names in the red. Surabhi.
Okay, I'm looking at IT stocks because that recovery move continues thanks to HCLTech's commentary. HCLTech, remember, is guiding for 2 to 5% growth in FY26. The reason that band is very high is because it all depends on discretionary spends. If they're bad, 2%. If they pick up, then 5%. That's the Nifty winner. Stock is taking the sector up with it. Tech Mahindra, 3%, Infosys, 2%, Wipro, 1.5%, TCS, 1%. So IT is a big leader. Beyond IT, IndusInd Bank is recovering with that clarification that the bank issued yesterday, 2% up. There is no forensic audit. It's only an EY sort of assisted internal review of the MFI business. Geo Financial, SBI, these are some of the other names. Axis Bank on the financial side that are doing pretty okay. Some recovery on a Hero Motor today. Remember yesterday, Bajaj and Hero were both hit hard because of the Jeffries note. Bajaj is still down, 0.7% lower on Bajaj Auto, but Hero Motor is having a better morning. What's not working is Kotak Mahindra Bank. There's a bit of a profit taking over there. Cipla, Grasim, these are some of the other stocks. But otherwise, it's fine. It's a full green screen. No problems whatsoever. Eternal continues to have a great run. Eternal this month in April is up 20%, Zomato. And that continues with today's move, 1% higher.
Okay, all right. The stock of the morning is Cyan DLM. We just had the management on the channel. They said that the last quarter had a one-off positive impact on the margins. And for the coming year, they are guiding for 10 to around 12% margins. And the US business could be better placed with regard to an opportunity on the China Plus One theme. So that stock is up close to around 9%. Bari Energies, that's the stock of the morning, up close to around 6%. Big move is what we're seeing. And it's having a positive impact on other solar module as well as cell makers. You have Premier that's up close to around 2%. You have Insulation Energy, that's another smaller name in there. That one as well is up close to around 3% or thereabouts. Pull up a couple of other notable movers. You have Geo Financial Services, the new entry into the Nifty. That's up 1.5%, and it's moving on rather large volumes. So good going on that name as well. The first tick, just one observation, on the Nifty, the first tick was a gain of around 200 points, but that quickly got sold into you. So by the end of today, you'll want to see the 24,350 mark get conquered on a closing basis, and you'll want the Nifty Bank to get past the 59,000 odd mark. As we mentioned earlier today, the sector of the morning is the IT pack. You have HCLTech that did quite well in terms of in comparison to street expectations. The Nasdaq saw a relief rally, and we had more rational thoughts coming in from President Trump. So that explains why. That's the sector of the morning. The tech pack up and about in today's trading session. Just one more name. J&K Bank is down close to around 6.5%. I think yesterday that stock had seen a big run. Today it's come in for some profit taking.
I just want to point out Havells, guys, before we move on. A little uncanny, 3.5% down. The numbers look good. Most of the brokerage notes that I'm looking at, Morgan Stanley overweight, target price 1942, Nomura buy 1873. JP Morgan is neutral, but even their target is about 1700. Stock selling off quite a bit.
I'll give you a couple of reasons. One is their switchgear business, which is the highest margin business. Out there, the growth is only 6%. Point number one. Point number two is the stock trades at around 60 times on a forward basis. That's FY26. That's 30% above its historical 10-year average. Both these 2 points coming in from a Jeffries note. So that could explain the stock is seeing some profit taking.
All right. That's Havells. Well, 140 higher on the Nifty, which means, I think from the high point, we've lost about 60 odd points. But this is very, very initial first few minutes, which is coming up on our screens for now. 24,300. The biggest volume-led gainer this morning is Vari. It's got about 500,000 shares, I think. But it's the number one volume-led move. 1.5 million, beg your pardon, 2750. HCL and Coforge are the other two names. Coforge is up about 3%. AU Bank, will speak with them in a bit, 4% higher. Tech Mahindra, Chola Finance, Keynes, Cyan, DLM, and so on and so forth. And then volumes start to taper off. But it's a strong start in terms of volume-led gains as well. Raj Ratan Wires, right? We had the management with us yesterday. It ended up 20% yesterday by 3:30. It's up another 7% this morning, 415 or so. From a low of about 260, stocks at about 420 in about, 6-7 trading sessions now. So these are very big moves which are coming through. Vetri Subramaniam is with us, Chief Investment Officer at UTI Asset Management Company. Vetri, good morning. Good to have you with us here. Thanks very much for your time.
Good morning.
Is it all clear, Vetri? And we are again, markets are snapping back. Stocks are snapping back 20, 30, 40% very quickly. And you're right back to where valuations were. And valuations were a problem, right? When we were talking about it a month ago, 2 months ago, etc. What's your sense, Vetri?
Sure. I think one round of the panic to whatever developments were happening on the tariff front and the worries about, how long the uncertainty might persist. One round of panic, I think, related to the market has played out. My sense is that the longer term ramifications are still, sort of unclear. The good news from an Indian perspective, really, so to speak, is that we know that, our exports to GDP in terms of the first order impact, in terms of the export of goods, is only 2% of GDP, right? So there's only a limited extent to which the US, tariff war has a direct impact on India. But obviously, we have to worry about second order impacts. And good to remember that second order impacts can both be opportunities as well as challenges because, if people are not able to export into certain geographies, will they try to dump elsewhere, so on and so forth. And at the same time, if tariffs are higher on certain other countries, it could be an opportunity for Indian companies. But I think really all that's happened is that we've gone more into a holding pattern right now. It's very hard for me or for anybody to claim that they have complete certainty about what's going to play out. And I worry that it's really that uncertainty which will continue to weigh down on the market at this point of time.
Okay. So uncertainties and lack of clarity, that continues. Vetri, good morning. Great to have you on. But, what I think a lot of people are pleasantly surprised with is the momentum that the market has found on the upside. And that's thanks to the flows, right? Every day we measure those numbers, count those numbers. 2,000 crores, 3,000 crores coming in from the FPIs. Let's talk about financials because they're directly benefiting from this return of the FPIs. And you've been very, very positive on financials, even when they weren't doing anything in the market. But how much of the good news is in the price? Do you expect a bigger growth kicker ahead? The numbers are looking pristine, no problems there. But what next?
Sure, Surbhi. The only point I will make, Surbhi, is that for 30 years, I've been seeing daily numbers of FPI and DII being reported, and I stopped looking at it 30 years ago because I figured that for long-term investment, who's buying and who's selling is really the most useless piece of information you can look at. So that's not what really drives my thought process. And again, in terms of FPI buying and financials, that's not the way I would look at it. I think what we need to keep in mind is that we had a monetary environment along with a fiscal environment, which was very tight, very conservative for the last 2 years. I think particularly on the monetary side, the interbank liquidity being negative meant that credit creation was being held back. You also had, maybe rightly so, the RBI making multiple interventions, raising risk weights, trying to sort of caution the banks from growing credit. And I think all of that contributed to a sort of managed slowdown of credit growth in the economy. You look at the year ended March 31st, credit growth in the economy is just about 11%, which is pretty much most likely 150 basis points higher than where nominal GDP growth is. That's a very weak pro-growth impulse from credit. I think one of the changes that I'm seeing in the last 2 months is really that RBI is now waking up to the fact that perhaps there is a need to put a little bit of growth impetus back in the economy. They are doing it through administrative measures. You've seen that even on the, sort of LCR ratio changes that they recently announced. They're allowing interbank liquidity to go positive. And I think we are perhaps now in an environment where credit growth can actually become supportive of economic growth. What do I mean by that? If you've got economic growth running in terms of nominal terms at 10% or thereabouts, you could actually be in an environment where credit could be running at 13 or 14% for the system as a whole. Also because it would then sort of support growth within the economy. And to the extent that we are facing, external headwinds, I think one of the levers available to us to support the domestic economy is credit growth, and the banks are in good shape. We know that company balance sheets are in good shape. Households, little bit of stress, but I do hope that the household balance sheets would have seen some healing because of this fabulous rise in gold prices. The Indian households are over-indexed on gold, but it's certainly healing their balance sheets.
So, Vetri, just to follow up on that, you're saying 13 to 14% credit growth system-wide. I'm not sure if that happens this year itself or not. In terms of multiple expansion, in the heydays, we've seen banks trade at 4-5 times price to book, NBFCs trade at 8-9 times price to book. Let's talk about the larger banks. I think most of them are still around 2.5% to 2.8 times PB. What is the valuation expansion in this leg of the financial run that you would anticipate?
Yes, Surabhi. My thought process is that a year ago, even when we spoke about this, I was talking about the fact that valuations were very, very comfortable. In fact, they were perhaps even cheap because, people were looking at the adverse news flow. And, my sentiment at that point was they are cheap because you're looking at the adverse news flow, not at what is possible. I think we are now in a phase where perhaps the market and, at least as investors, we should be looking at the fact that I think there is a scope for credit growth to surprise on the upside over the next 2 to 3 years. And I think as a result of that, you can get a combination of both earnings compounding and some improvement in valuations. Those numbers that you talked about in terms of price to book that we've seen for specific financial institutions in the past are not a benchmark. That's certainly not the number that I would be working with in my head. But is there scope for margin expansion? There certainly is. And I would also argue that, in this kind of environment, many of the banks, not all of them, many of the financial companies will be able to grow without diluting because at their current level of ROA, they can easily sustain 13-14% credit growth without seeing any rundown in their capital adequacy ratios. So it's a sweet spot for them where they don't need to raise equity money to actually deliver balance sheet growth. And therefore, it's very self-sustaining in terms of the outcomes that you can experience as an investor.
Hi, Vetri. Good morning. Good to see you. When I recall in Feb as well, we had a chat, right? At that point of time, you said BFSI, that's your sector that you like. It's going through a bit of a knock, but you said that that's one of the top sectors. And the other one you mentioned, I think, was the power stocks. Post the pullback, you said that maybe some of them look interesting. Are both those two still, we've already discussed banking. What about the power stocks?
I think power is a little bit more tricky because at the end of the day, it is a utility business and therefore you've got to be cautious about what you're willing to pay for it. And I just think there are many moving parts over there in terms of everything that's happening, particularly in terms of the new energy and the solar piece. But I think in India, increasingly, we will find that a lot of our requirements in terms of powering the grid for growth over the next decade will come from traditional fuel sources. And I think there are a bunch of, local companies which are well placed. Also, you will have, interestingly, I think some opportunities in the transmission side, because the more complex the grid gets in terms of the sources of power, actually, it's the transmission companies which also start to benefit from that. So I think power is something I'd stay reasonably positive and constructive. But remember, it's eventually a utility. Returns are regulated, and there is a scope for policy intervention in multiple manners.
Vetri, just thinking ahead a little bit, do you think, right now we're in a bit of coming off very beaten down levels and there is generally a bit of a risk on, but with regards to India, all commentary, etc., seems to suggest that we are first in line for a deal. But even then, there is wide acknowledgement that it will take time. I mean, it's going to be many months away, right, for a final comprehensive deal. Do you think, as we get closer to the 4th of July, I think 4th or 6th of July, which is a 90-day cutoff, 90-day pause, say after another 20 days, if there's nothing which is moving forward, once again we will enter that period of uncertainty and people will start to question what happens, etc., etc.?
Without doubt, Prashant. But I think we need to step back for a moment. Forget the uncertainty that perhaps people who are trying to day trade the markets are facing, or even we are obviously dealing with very uncertain events. But think about what's happening to the economy. You've got businesses going on hold because they really don't know how their supply chains are going to behave. They don't know how long they will be able to hold their price line. They don't know in which geography and where they should be making investments to build their new factories. And if they take those decisions, they don't know whether they have the certainty of policy. So really, I think the bigger concern is, markets can keep repricing things instantaneously. But I think the bigger damage which is happening to decisions being made by businesses, by industries, and eventually some of that flow through to consumer. And that is what would trouble me, because when I look at the Nifty consensus earnings growth of 13-14% for FY26, that is not a low bar. It doesn't sound like a high number, but in an environment of uncertainty where everybody is going to be cautious about building that next new factory, consumers are going to be worried about, hey, what's the outlook for my industry? What's the outlook for my income? Should I be buying a car? Should I be buying a house? Should I be putting money down on something? There is a scope for things to slow down. And it's that earnings concern that I think I would worry about a little bit more. And the simple way in which the market tends to deal with earnings uncertainty is pushing the multiple down for earnings. So I would still, in that sense, say that, don't go by, okay, the market sorted because it's up today. Don't go by everything is busted because market is down today. We are in an environment of uncertainty, and you need to build that into your investment strategy.
You preempted my next question, Vetri. I'm so glad you brought up that point. So, X of the US issues, let's leave that behind. I mean, assuming for a second that we get a deal and it doesn't all, go to hell, so to speak. Earnings is one worry. Is there anything else that's a risk to this market's bull run resuming?
I don't think about the market in terms of is it a bull run or is it a bear run. I think to me, the bigger issue is what's the kind of outlook we have for growth. I think the great thing for India at this point of time is macro stability is fantastic. But, in terms of being to accelerate to a 7.5% growth, I don't see that visibility as yet, because I think we are still in a very difficult global environment, though our macro platform is stable. What we could benefit from, but that's only the capital side of the equation, is once the dust settles, I think the outlook for capital flows into EMs and into India would improve. And I don't mean FPI money. I mean even eventually FDI money, which I think is really very, very important to the country's long-term growth trajectory.
All right, Vetri, great perspective as always. Thank you very much for joining in. So optimism, but laced with a bit of caution, and that never hurts, right? Thank you so much for joining us this morning. Well, we were just talking about the banking sector, which has become sort of a consensus buy trade in the market. Vetri is also saying that maybe credit growth can surprise on the upside. Let's actually put the spotlight, because a lot has changed in the last 3 months since we had a change of guard at the Reserve Bank of India. The Nifty Bank is at record highs. Ritu is here to tell us what all has fueled this rally from a regulatory perspective.
Well, a spate of positive developments for the banking system that could explain the rally we're seeing in banking stocks. But at the heart of it is a regulatory environment that is turning more supportive under RBI Governor Sanjay Malhotra. RBI has deferred tighter project finance norms, and they've even provided banks additional time to comply with these new LCR requirements. And to the street, that is signaling a clear pro-growth stance. Adding to the momentum, systemic liquidity has also flipped into surplus after a 4-month deficit, with the RBI injecting more than 15.5 lakh crores in the system in the recent months through OMOs, VRRs and forex swaps. Now, while the recent 50 basis point rate cut may weigh on bank NIMs, it is aimed at boosting credit growth and demand, and CRISIL expects credit growth to rise by up to 200 basis points this fiscal, helped by these tailwinds. The strong show by banks like HDFC and ICICI Bank in their fourth quarter has also helped boost sentiments. Now, on the regulatory front, these latest LCR relaxations are a big positive, because compared to earlier draft norms, the final rules are more lenient, and they are expected to improve the aggregate LCR of banks by 600 basis points, freeing up almost 3 lakh crores of lendable resources and potentially lifting the overall credit growth by up to 1.5%, according to ICRA estimates. RBI also recently lowered the risk weight on bank lending to NBFCs and MFIs. That could free up an estimated 40,000 crores of capital. Now, co-lending norms, they've also been expanded to include all sectors and all regulated entities, and even priority sector lending norms have been revised, enhancing the loan limits and broadening the scope for renewable and housing credit. So put together, it is a powerful combination of ample liquidity, regulatory easing, and strong earnings that is fueling this banking rally. But that said, not all concerns are off the table. Deposit and credit growth momentum remains a key watch point, and there are still some lingering risks around asset quality issues in unsecured loans and microfinance segment.
Okay, Ritu, thanks very much for recapping everything that's happened. That has given definitely a lot of regulatory comfort to banks and bank stocks. To talk about this and the way forward, we have with us Mr. Dinesh Khara, former chairman at State Bank of India. We also have with us Sanjeev Chadda, former MD and CEO at Bank of Baroda. Gentlemen, thank you very much for joining in. Mr. Khara, let me start with you. So it's been a very swift change in, well, the stance changed a little later, but a swift change in the regulatory backdrop, where a lot of the macroprudential, tightness that we saw in the last 15 months, that has been pulled back, whether it's unsecured retail credit, whether it's sort of risk weights, or look at the latest, which is the LCR guidelines, right? There's been enough comfort. The implementation is also 1 year away now. What do you make of Mr. Malhotra's first 3 months in office?
Well, I think the way I read this situation is that the industry was always reaching out to RBI and was making a very appeal, significant appeal in terms of ensuring that the liquidity should not become a challenge. Particularly, I'm talking in the context of LCR, and I'm glad that the guidelines which have come in, it's actually a middle path. If at all you look at it as compared to what it was, and now what it will be from the 1st of April 26, it's more like a middle path. And I think that is a very clear reflection that RBI has probably given due credence to the submission made by the industry and the industry body, and have also tried to figure out that how should they balance the risk also, which are inherent in this. So I think I would say that it has always been a collaborative approach, but I think as a regulator, they are very mindful in terms of the situations which are obtaining, and based upon that, whatever elbow room is available, I would say that they are willing to accommodate the banking system. Very mindful of the fact that growth is the need of the hour, and unless and until the banking sector is given the required support, growth may not really happen. And that is perhaps the reason why RBI has also taken a stance which is supportive of the banking requirements.
Mr. Khara, so the RBI usually errs on the side of caution, right? So just your thoughts, you mentioned the LCR norms, just your thoughts on the pullback in the tightness or the regulatory tightness around unsecured lending, right? Like I said, that some of the risk weights that were increased for NBFCs, they've been now rolled back. On the unsecured bit, do you think this was the right time to ease up norms a little bit? And what would you expect in terms of pickup of unsecured credit?
No, I think the way I read it is that, by virtue of tightening the unsecured credit, it was actually had started impacting on the growth path. So naturally here also RBI was required to find a middle path, and that is one of the reasons why I think they have left the micromanagement as far as the risk is concerned for the unsecured credit at the level of the board of banks. But overall, they have given some elbow room, which is actually addressing this particular aspect. And the other aspect, which I must mention, it's not merely the RWA which has been reduced, but also to really support the whole ecosystem, the co-lending requirements which have been relaxed now, that actually makes the availability of credit at the ground much easier, because today NBFCs can do co-lending with themselves. The other NBFC players, NBFCs can do co-lending with the banks, and even banks can do also do the co-lending. So I think among themselves, actually, they have broadened the whole base. I would say that the reduction in the RWA was essentially just one step, But essentially, the direction is very clear that how can we make the credit available on ground without much of cost. So that is what the intention seems to be. And that is the reason why the RWs have been relaxed a bit. And also the co-lending environment has been created. Very positive co-lending environment has been created. But nevertheless, managing the risk is something which is the role of the management of the banks. And for that matter, the board of the banks have got a greater responsibility. And I think I expect that the board will take the appropriate call depending upon the area where they're operating, the products which they're offering, and how they should.
Absolutely. Very good points, Mr. Khara, and good to see you. Good morning, Prashant here. Mr. Chadha, welcome to the program as well. With the caveat that stock markets generally love to jump to conclusions that, this is a big shift from an earlier stance, and mostly they'd like to believe that things are getting better. I mean, markets are optimistic creatures at the core. Can we say, in the context of what we've seen from the RBI under the governor over the last 3 months, that there is a shift to kind of focus towards growth in a big way? I mean, just for example, take the case of this LCR, right? The runoff at 100%, banks were arguing, was punitive. But the very sharp reduction which we've seen, perhaps on the other end of the spectrum now, what do you say? As an indication, can we say it's very, very growth focused now? Mr. Chadha, you want to come in?
Yeah. So I think probably we need to look at it in a broader perspective in terms of what guides central bank in their policy at what point in time. I think central banks generally would want to be counter-cyclical, right? If there's stress building up in any area, they would want to mitigate the stress rather than accentuate the stress. So we know that there was tightness in liquidity. We know deposit growth was slowing down. And therefore, if the draft guidelines of the LCR had come into effect, that would have been pro-cyclical rather than counter-cyclical. So one can argue that this is pretty much broadly in line with the mandate of a central bank, right? That's one. Number two, the specific context of the Indian economy. We know that unlike, say, the US, the Indian economy is completely dependent upon banks in terms of providing credit for growth. And therefore, if the emphasis was on growth, there was no case, again, for tightening liquidity and making things difficult for the banks. In fact, in that case, the growth agenda could not have been met. Third, I think that particularly when it comes to the LCR, rate cuts already were there. And therefore, now if you want that the rate cuts should be transmitted, it was important that liquidity should be eased. Banks should not be looking over their shoulders in terms of what is going to be happening in 6 or 8 months' time. So I think while you are right in terms of the fact that there may be some signals to read, but these the changes that are there are perfectly understandable and justifiable in terms of the mandate of a central bank to ensure that there is growth, to make sure that there is counter-cyclicality in policy, and also make sure that the rate cuts actually get transmitted in a broader sense.
Mr. Chadha, sir, same question to you. What sort of a growth kicker will all this translate into? Because like Mr. Khara said, there's the relaxation in LCR norms. There is the rollback of risk weights for NBFCs, relaxation on unsecured credit, boosting co-lending in a big way. So what is the growth kicker, system-wide credit offtake, say in FY26 and maybe FY27, when the benefits of all these measures really pour in?
So I think Mr. Khara is absolutely right. Ultimately, credit policy, like politics, as they say, is the art of the possible. There are some areas where challenges do remain, right? So we have been looking at the corporate credit growth, the investment cycle. Now, those are things that you cannot switch off again at the press of a button. But there are things which are within the ambit of the central bank. And as Mr. Khara rightly pointed out, when it comes to unsecured loans, they have become an increasingly large part of lending, both for NBFCs and also for banks. Given the fact that other avenues of growth are not there, possibly this is something that you must do while making sure that the prudential requirements are not really put aside. And I think that is completely demonstrated by the fact that when it comes to the runoff factor when it comes to digital deposits has been increased by 2.5%. But I think the stance of the RBI would seem to suggest that they are fully cognizant of prudential requirements, but they will make sure that banks get sufficient time to adjust so that any policy action of the RBI is non-disruptive as far as growth is concerned.
Okay. All right, gentlemen, thank you very much for that perspective. well, it's definitely showing up in the market excitement, and hopefully it will show up in terms of growth numbers in bank earnings as well in the quarters ahead. Thank you so much for joining in.
One last
Prashant, absolutely.
Yeah. Mr. Khara, what else should we expect, sir? Let's look into the future quickly, if you can tell us.
No, I think what I would say is that the way
on the regulatory side, sir, in terms of all the relaxations we've seen, is there anything on the agenda in terms of something where discussions were taking place over the next few months? What should we expect?
No, I think more or less they have already adjusted, already taken care of. Liquidity is one of the concern areas. And of course, there was what was being talked about was that if at all there could be some kind of a relaxation for the CRR, maybe in the days to come, to ensure that there is a durable liquidity in the system, perhaps that could be one thing which we can look at. We can look for.
Okay, so we'll look forward to that if it were to happen. But I mean, the indication and signals, if one wants to read, clearly seems to be that the central bank, of course, I mean, absolutely prudent and have taken care of risks in the system, etc., but also an eye on growth. Thank you very much, Mr. Khara, Mr. Chadha, for joining us. Good conversation and good perspective from both of you on what's happening in terms of all these regulatory relaxations and much easier liquidity now, even compared to where we were at the beginning of the year. We'll take a quick commercial break here. We have Kunal Vora of BNP Paribas joining us. Expectations from the FMCG space, quarter se quarter tak. So that's coming up.
Welcome back. Well, quick check on the market before we proceed. And the market's just fine, 170 points up on the Nifty. And today it's not the Bank Nifty. The Bank Nifty's taken a breather. It's done the heavy lifting for so many days. It is IT, and IT. Look at HCLTech, 7%. Tech Mahindra, Infosys, Wipro, big move on all of these stocks. That's IT. What about FMCG? Will this engine start firing up for the bulls as well? What does Q4 have in store? It is time for our special segment, Quarter Se Quarter Tak. And yes, you guessed it, we're putting the spotlight on the FMCG space in this season. Over to Mangalam for the key expectations.
Well, for the FMCG sector, in terms of the fourth quarter, I'll have to use the old ad tagline, same, yet different. Why do I say that? Because it's going to be a quarter of muted staples volume growth with good rural growth. However, urban outlook is improving post the budget and raw material prices remain volatile. But they are higher in the fourth quarter. They have come off as well. Case in point, palm oil itself. There is strong competition across categories, but leaders are making a comeback in a few categories as well. Discretionary like jewelry, beauty and personal care, quick service restaurants, value retail are likely to outperform. And that's something that we saw in the fourth quarter updates that have come so far as well. Jewelry names like Titan and Kalyan Jewelers have, been top of the pops. Trent too, despite growing at a lot slower rate than its own past performance, was among the top quartile with a 28% growth in the fourth quarter. Nykaa continues to outperform the sector, and this time around, we will see some revival in revenue growth coming in from names like V-Mart as well as D-Mart. Jubilant Foodworks continues to do well. The staples, however, continue to drum in their own beats, which are soft and muted. Dabur said its India business will decline in mid-single digits, 150 to 175 basis points margin dip expected as well. Marico, on the other hand, saw sequential uptick in underlying volume growth, which is a positive, but margins are key to track there. and Godrej Consumer as well, with underlying volume growth expected to be in mid-single digits after a weak third quarter itself. What are we expecting from numbers this time around? We have Tata Consumer reporting, then in the very near future, we have HUL and Nestle reporting as well. Well, if you look at it, from what we saw in the third quarter, not much is expected to change, but a notable underperformance from names like Asian Paints, where revenues are likely to decline 1 to 2%, EBITDA are likely to decline 2 to 6% as well. We're expecting margin compression for both Britannia as well as Tata Consumer. HUL, on the other hand, likely to report low single-digit revenue and EBITDA growth with absolutely flat volumes. So what's different this time around? Well, the expectations of a better FY26 are a lot more due to the projection of a normal monsoon, impact on consumption led by tax cuts and government stops, improving urban demand outlook as well. A lot of acquisitions made by companies in the recent past could start scaling up too. And in terms of valuations, the sector's never been cheap, but this time around, after a spate of underperformance, traded multiples are near 5-year average for most of the companies, and that may give some solace to those looking to invest in the sector at the ebb of a cycle. In fact, very recently, we saw a couple of brokerage upgrades coming by on the sector as well. So if you look at the valuations, compare that to 5-year average, we will see some bit of moderation coming in, maybe the street looking at the cycle to move. What will set this quarter apart from the previous few is that the management commentary may be a lot more optimistic than earlier, which is why weak results may not be as punished as earlier. Therefore, like I said, same, yet different.
I forgot whose tagline that is, Mangalam. My God, I think I'm getting old. Which ad was this?
That's a quiz for all the viewers. Google and find out.
Okay, I'm completely intrigued and I'm going to definitely look this up right after the show. Thank you so much for that. Let's take the discussion forward. We have a sector specialist also joining in. Kunal Vora, Head of Equity Research at BNP Paribas, is with us now. Kunal, everyone's waiting for a revival in these FMCG stocks. Now, as Mangalam told us, the numbers are not showing that up. If anything, we might see a decline now at the EBITDA level for many of these companies, Tata Consumer being an exception. What's your overall stance on the sector?
Yeah, our view on this sector has been negative. FY25 will be another year in which we will not see anything meaningful in terms of revenue growth or EBITDA growth for the year. FY25 will be a year of low single-digit revenue growth. EBITDA could be flat for our coverage. Now, on a very, very low base, FY26 will be a better year. I mean, there has been no growth in FY25, so things will recover in the next few quarters. Rural indicators are looking positive. Government spending, government has done more for affluent consumption compared to mass consumption. So I don't really see that as a trigger. But inflation has started moderating. Raw material cost, agro commodities have been elevated, but that's something which is now stabilizing. So in FY26, we expect the growth rates to come back to more normalized levels, about 7-8%. That's the growth rate which this sector has seen over the last decade. But if you look at, say, 3 to 5 year CAGR, the sector has been a fairly weak one. And besides just the fact that the growth has been weak, we see a higher disruption risk in this sector compared to what we've historically seen. And in that context, we find the valuations to be fairly rich. So our view on the sector remains negative. In fact, from India strategy perspective, this is a key underperform rated sector for us.
Key underperform rated sector. Okay. Though you're expecting for the FMCG, the staples basket, growth should pick up to 7-8% this year, right? Which will be great. I mean, we haven't even seen that kind of number in such a long time. So discretionary consumption is relatively what the market is obviously more optimistic on. I don't know if you cover those companies as well, say the likes of a Eternal or a Nykaa. They represent a different format of consumption. What would your expectation be here in terms of earnings? Will the earnings continue to surprise on the upside?
Yeah, so we have certain discretionary names under coverage. In fact, we also have a basket of 50 stocks which cater to the affluent India. And we believe that affluent India is the story to be in when it comes to consumption. You've seen various factors driving it, job creation, rising access to credit, strength in asset prices. All of that really helps the affluent consumption. And some of the names which you did mention, along with what we cover, like some names in jewelry, QSR, food delivery, all of that really caters to the primarily to the top 10-15% affluent households. Where we see the issue is much more in case of the mass consumption, which is where the staples fit in. And we don't really see anything major changing there. It's been a weak growth, consistent underperformance compared to nominal GDP growth rate, and that's something which we don't think will change. Now, growth of 7-8%, I mean, yeah, it's a recovery compared to what we are seeing, but nothing really exciting. When stocks are trading at 50 to 52 times FY27 P multiples, we don't really find the like 7-8% growth or flattish EBITDA margins to be very exciting.
Kunal, are you allowed to share your top picks on air with us? Please do if you can.
Yeah, we like, in the discretionary space, we like Titan. In case of consumer staples, we do like ITC. And we do like HUL purely because of valuations. The stock is now trading at 1 standard deviation below its historical averages. But growth rate, we continue to believe will be fairly muted for this sector.
All right, Kunal, we'll leave it there and speak again soon. Thank you very much as we continue to track this hopeful recovery, as far as staples and FMCG stocks are concerned on the back of, I guess one of the things, of course, is more money in the hands of the consumer. Well, more money in the hands of the consumer hopefully also means better credit revival. So let's go back to the banking financial services space and let's talk to the management of AU Small Finance Bank. The reported numbers, stocks higher, 20% year-on-year growth, 6% quarter-on-quarter growth, healthy growth in the secured portfolio, including mortgages. And there is a lot to talk about here. Sanjay Agarwal is founder and managing director, CEO at AU Small Finance Bank. Sanjay, good morning. Good to have you with us here. Prashant, this side.
Yeah, Prashant. Good morning.
Good to see you.
Good morning. How are you?
All well. Thank you.
Yeah.
So, the question is about, we were looking ahead, right? We just had a discussion at 9:30 with Mr. Dinesh Khara and Mr. Chadda on all of the regulatory relaxations with regards to liquidity we've seen from the beginning of the year, and things seem to be much better. But let's talk about your business. We've seen healthy growth. What can we expect in terms of growth for FY26, Sanjay? And also give us a sense on asset quality. Do you expect some challenges to persist, at least in the first half of 26? Go on.
Yeah, Prashant. So again, thank you for this opportunity. So let's go back, last year when we all started 24-25, we never felt that, we'll go with this tough year, the challenging year. So in my opinion, we were not prepared, because we all forecasted 7% GDP. We all thought that there will be enough liquidity, inflation will be under control and all those things. But somehow, last year remained very tough in all sense. Our GDP never performed, broken momentum, I would say consistent liquidity issues. So I think from last 2 months, things have changed dramatically, in my opinion. And I would give credit to the regulator and, of course, the government itself that the focus on growth is back. But I think we need to also figure out that we are just forecasting a GDP of lesser than 6.5 for this current financial year also, right? And we are just starting this year. So to build anything from here and give you guidance at how much growth can happen and how this year would not be right at this moment, in my opinion. We need to wait actually how it's actually pan out. But I personally believe that this time we are well prepared, because, I'm a cricketer. I know that if pitch is, if you don't able to estimate the picture, then you can't able to perform.
No, that point is taken, Sanjay. That point is taken. That last year we started on a high note. The economy itself, policymakers, everyone were on a jubilant note, and therefore not prepared for what followed. But now we are prepared for the worst because of whatever Trump has done, and therefore perhaps we'll do better. But let us just do the little bit of math that Prashant was asking you. Are we going to see an improvement in margins? Everybody's margins fell in FY25 because liquidity was tight and interest rates are getting cut. This year, because of liquidity, does 5.8 go towards 5.96? How do margins go?
No, so there I would say that still very early time. There is a narrative from the regulator that they will put liquidity and all those things, but the real action has to happen, right? So for me, the real interest rate correction or a margin expansion maybe in Q3, Q4, but I know that it will be in next financial year. That's for sure. But this year, I want to take a very guarded approach that, let's not build anything from this initial initiatives. Let's see, go more deep in the year, build your organization or a bank around these challenges, So I would say that ideally, I would love to say you that, there can be a margin expansion, but I also see the reality so that holds me back.
Would you need to,
jump in the
Sanjay,
conclusion that it will be all good time, right?
Got it. Sanjay, one of the things that analysts have been we've spoken with, has said, is that on margins, you will need to offer higher rates as compared to other lenders to attract deposits. And that may keep margins under some pressure. Is that a reasonable point of view?
Of course, and it's true in our case, Prashant, because we are a small finance bank. We are still not that in big league. Once we go to the market, our team gets a lot of questions around our SFB platform and all those things. So we need to price even by basis of 25 bips, And in our whole maths of ROA, 25 bips is a huge amount, right? So that's why I'm saying you that, these are the initial time, just happened in last 2 months. So let's go more deeper and let's see how the whole liquidity actually reality happens, on the ground, because liquidity in the bank at the bank platform or at a platform of consumer is different, right? So let's see how the liquidity is at the consumer end and how he able to build their deposits with bank and all those things. So need to see this in maybe couple of quarters. Then we will able to say this that what is the margin expansions, how we can pan out our whole year.
Yeah, get that, Sanjay. We don't have too much time, so if I can rush some more questions.
Yeah.
What Prashant and I are trying to ask you is, does it go to 5.7 or 5.6 and then rise in the second half? If you can give us some direction.
Honestly, Lata, difficult. Whenever we have gone in this kind of uncertain time, it's difficult. Something happened in next 1 month. Who will figure out that, how the real things happen? Because if you ask me in April, there is a softening of interest rates, in wholesale deposits. But if you ask me on the retail side, it is never happened at all as of now. So
all right. Let's shift gear to asset quality question, which we couldn't attend to at all. Can you just take us through whether you saw any improvement in MFI? When do you see it improving? You've taken a huge credit cost, almost 2.5%. I think you're providing 100%. Correct? So give me some idea of the actual behavior on the ground in terms of collections and asset quality and your reasonable expectation for next year.
So Lata, last year, there were two challenges, both on the margins and of course the credit cost, right? But I strongly believe that this year our credit cost will help us more to build our ROA. So I expect a reduction in credit cost this year, and I'm saying because we are well prepared. We know that how our retail asset, which is the book of us, is around 0.90 kind of credit cost, which may go down to 0.8 this year. Commercial banking is largely around 0.4. It may go down to 0.3. Microfinance, already I have seen the improvement in the Q4. So I believe that we have a credit cost of around 7.7 last year. This year, we expect to be around 4%, right? So I think overall, I would say the credit card, of course, we are actually going in a course correction, and we'll do a lot of things so that our credit cost gets capped somewhere in 10% in the range there. So overall, I strongly believe that this year, this financial year, 25-26, the credit cost should be in the range of 0.9 versus 1.3, which we had last year.
So MFI stresses, we've seen the worst, Sanjay?
Yeah, that's my sense. And Prashant, again, I will say that we are well prepared. We know that how the GDP will have, what GDP will we have this year, how the whole momentum will be built. We know that there will be heat wave in the 2 quarters, then there will be momentum built in the second half, all those things. So this time we are well prepared, and once you are well prepared, you can manage lot many things.
The sense I'm getting, Sanjay, from you is you are well prepared for slower growth. Last year we got slower growth. This year also, what you said, right?
Honestly,
forecasts are for sub 6.5%. Is that the way to read this overall? Yeah.
No, Prashant, I don't want to go with a prejudiced mind that everything has become good. There is a push for growth. I want to actually wait and watch the entire spectrum, play the ball when it's been delivered, right? So that's sense, we can actually, in this last year also, Prashant, we have grown our deposit by 27%, loan asset by 20%, So in that tough time also, we have grown so well, right? So, but, the idea is to not to commit yourself in your team that we need to do this, irrespective of the condition, right? So the idea is to really be more balanced in your approach and play a inning, with the environment.
No, sure, absolutely. No, I understand that for your teams, maybe you don't want to put, undue stress and put a number to, to their head.
Yes.
But from a shareholder perspective, sort of rough ranges help to map the year ahead. So let's talk FY26.
We committed that, if India grow by, whatever nominal GDP, will grow by at least 2 times to that, right?
Okay.
So
2 times of nominal GDP. So, we should expect growth in double digits. Just on the MFI part, you said the worst is behind. Our team is just, seeking a clarification specifically on Karnataka. Your issues in Karnataka that you are facing, are you past the worst there as well?
Yeah, so I would say March has given us hope because in March month, the OD recovery there is around 98%, right? Which was around 95 in the January month. And I'm not seeing many noises from that market now. So, and that is only a 10% of our book. So even that, we have counted that book in our current year planning, right? So I don't think Karnataka would play a spoil sport for us this year.
All right, got that point, Mr. Agrawal. Thank you very much for joining in and giving us a perspective on the business. That's AU Small Finance Bank. The stock is doing really well, 5.5%. You can't say that for the overall Bank Nifty, however. There's some red on the screen now and some selling that's crept in the last 20 odd minutes or so. Let's pull up the Bank Nifty. It's down about 0.4%. Market has also cooled off because of the profit taking that we're seeing in bank stocks. Maybe it's just that tactical profit taking, given the very sharp rally over the last couple of days. Good time to bring in Mitesh then. Mitesh, actually, let's start right there on Bank Nifty. If anyone's got open, long positions, what do you make of it? Where do the supports come in?
Yeah. So I think the Bank Nifty, I think first signs of, profit booking are there on the half-hourly chart. But again, this will not really worry me a lot. There is, there was always a chance of some pullback with the kind of rally which we have had. Good idea would be to take some profits off the table and then wait for an entry point closer to about 55,000 levels. I think 55,100 is my zone where I would want to buy the Bank Nifty again. So stay long, but I think, stay on the positive side of the trade. But tactically, I think taking some profits off 50% off is not a bad idea. And add on a decline.
You were saying in the morning, right? I mean, so 200 higher, and if you get a 80, 100-point pullback, and that perhaps is the time, that's the place to kind of go long, which is where we are now, right, Amitesh?
That's for the Nifty, Prashant, right? I think, yes, I think I'm comfortable buying into Nifty. Keep a stop below 24,140, which is about 105 points lower from here. And long positions can be slowly accumulated on the Nifty. Okay, your stocks, Mitesh? So I have a buy on Alchem Labs with a stop at about 50.40, the target of around 52.30 can possibly be looked at. The other stock which I like is from the IT pack. I think that's one sector which is reversing a bit. Disclaimer, we have some call options positions of invested interest over here. And that's Tech Mahindra, which I would recommend buying with a stop below 14.05 and look for target in excess of 1500. Okay. The broader, thanks very much, Mitesh, for that. The broader US market recovery may or may not have an impact on the broader Indian market, but one sector which certainly pays attention is the IT services index. The Nifty IT index is up 3%. Of course, it's also the worst performing index this year so far, worst performing large index, 3% plus, 35,075 is where we are at. We take a quick commercial break here. We turn our focus to commodities with Manish on the other side. Stay tuned.
Welcome back. Well, we've spoken enough about equities. Let's also put the spotlight on commodities because guess what? After shining to 3,500, gold prices finally have taken a breather. Let's talk to Manisha. Manisha, what's the latest?
Oh, well, yes. 3,500, done, dusted, been there, done that, and we've seen some profit taking. Well, the interesting point is that after hitting $3,500 an ounce, there was a bout of profit taking correction on the lower side. So prices did hit that record highs, with the various global banks and brokerages have been talking about. And they've also been saying that 3,500 would come in by April and it would peak out by May, is what we've been hearing. But 1.2% of a decline in the overnight markets is what we've seen in gold. Interestingly, even as gold made that all-time high yesterday, it closed much lower at $3,380 an ounce. So that tells you on charts, while we've seen that spike, we haven't closed there. And that has led to some more profit taking happen in the Asian markets right now. Also, gold is showing some exhaustion now, finally, after gaining $850 an ounce in this year alone since 1st of January. We started this year with $2,650 and we've done $3,500 on the higher side. So that's almost $900 plus kind of a rally that we've seen in the intraday market there. These are the Indian gold prices then. Well, we've seen an all-time high of 99,400 already there. Add 3% GST to that. And that's exactly what we've been talking about in the last 24 hours on the kind of run-up that we've seen in Indian markets. And ₹1,00,000 per 10 grams, it has been a reality. But for India as well, we're trading at around 95, 96,000 right now. So it's nearly 3,000 rupees off in the Indian markets from those all-time highs. What's leading to this decline? Well, one is the dollar index, which has come off its oversold zones. It's trading above 99 right now, and that has led to some profit taking. The equity markets in India globally have seen some stability coming in. That has been the reason. And then the couple of statements coming in from US, one from the US Treasury Secretary saying that they expect de-escalation in US-China trade conflict has led to the decline. And the other has been US President backing away from those statements that he earlier made on threats about firing perhaps Fed Chair Powell. So that has led to some easing in markets as well. The other thing worth watching is that COMEX inventories had hit an all-time highs. They have seen a 2 million ounce decline since early April, now stands at 43 million ounces. The other thing is the IMF statement that came in yesterday about the global GDP, US GDP being downward revision. That also is something that the street will watch out for. In the longer term, that will support gold. But in the near term, everything really seems to be impacting the prices right now. Long term, and let's talk about that now, and that is still bullish. If you look at the global ETF holdings, they are at September 2023 highs. Indian ETF holdings have been at the highest level as well. The US gold ETF holdings are at an all-time highs also. Also, the global central bank buying has just about continued for the month of March as well. And then now there are statements from China that they will now invest in internationalizing the Shanghai Gold Exchange, also the warehouses for global delivery. This is clearly coming in competition of the LME and the LBMA. So this would be an interesting development to watch out for. My last plate shows you on what is the gold outlook from here on now. With 3,500 done, and we are up 30% in this year. In last 12 months, we are up by 45 or 46%. The banks do believe that near term, there could be some correction coming in. There are various banks now saying that with 3,500 done, 3,200, even $3,000 an ounce, a correction until then is a possibility. But then come by the end of or the second half of 2025, there are higher targets coming in. Deutsche Bank, for one, believes 2,900 would be back by the end of this year. And then you also have Goldman Sachs talking about 3,700 by the end of this year. ANZ talks about 3,600. So slightly higher levels from there. But when you look at 2026, many of these banks and brokerages are still talking about 3,800, 4,000, 4,500 by the end of next year. So, well, yes, near-term exhaustion and correction, but longer-term still bullish.
Okay, all right. Manisha, thank you very much for that. So, yeah, those gold price targets are still very lofty. By the way, Prashant, just checking the market, it's come off very, very swiftly. The Nifty is up barely 23 points right now. But I think we have the Home Minister speaking on the Kashmir situation. We have visuals actually coming in. The Home Minister is indeed in the valley, and he's paying his homage to the victims, to those who, of course, have passed away in the very, very unfortunate and horrific attack. So visuals there coming in from Kashmir. But with that, maybe technology, because that's the only part of the market that seems to be holding up right now.
Absolutely, and 3% on the IT index at this point. Rima is here with a quick roundup of what's leading to this excitement, small bit of excitement. Rima, over to you.
Well, it's the rubber from NASDAQ overnight, but I just want to quickly recap how the quarter has been for the large cap IT companies now that all the four of them have reported their numbers. Well, on the whole, Q4 has been a soft quarter. Revenue for all the four IT company, large cap companies declined on a quarter-on-quarter basis. The steepest decline seen was for Infosys with a drop of about 3.5%. The commentary from the companies were also fairly cautious. They said clients are in a wait-and-watch approach. There are delays in starts of new projects. Discretionary spending is likely to remain subdued, and the companies fear stress, particularly in the automotive vertical, which falls under manufacturing, and then the retail CPG vertical. That said, cost optimization deals are very much on track. The silver lining in Q4 were the very strong deal wins across the board. Look at the numbers. For HCLTech, deal wins were up 40% on a sequential basis, nearing $3 billion. TCS's order book swelled by 20% quarter-on-quarter to $12.2 billion. Infosys' large deal wins were up 6%, while for Wipro, TCV, that's total contract value of deal wins, was nearly $4 billion. Again, a jump of 14% quarter-on-quarter. So even though Q4 got impacted on account of the macro uncertainty, the deal wins continue to remain very robust. Now, the FY26 guidance. Well, Wipro's Q1 guidance, which is the near-term guidance for the next 3 months till the June quarter, was a howler, -3.5% to -1.5%. But if you strip that out, for the full year, the guidance is not as bad as what the street was fearing. Infy is talking about 0 to 3% growth, HCLTech 2 to 5%, and TCS is saying, at least for their major markets, which is stripping out, India, the BSNL deal, FY26 should be better than FY25, and margin guidance has remained unchanged both for HCLTech and Infosys. And when you round up FY25, well, it's been a very low growth year. For Wipro, it's the second consecutive year of a top-line decline, but even for the others, like in HCLTech, Infy and TCS, we are looking at just about a 4 to 5% kind of a top-line growth. And FY26, by all accounts, and the FY26 guidance is again going to be a very low growth year for the, at least, IT companies, large cap IT companies. Back to you.
All right. Thanks very much. You're a useful roundup there. And as far as IT is concerned, Rima, thank you very much. We'll take a quick commercial break here. On the other side, my colleague Lata will be in conversation with Anil Rai Gupta of Havells as they discuss the fourth quarter numbers and the outlook for 26. Stay tuned.
Welcome back. We continue with our earnings analysis. Havells' Q4 results were a beat on, I think, almost all parameters. Revenue of Lloyd and of the cables business was way above expectation. Margins, I think, are a beat practically across all categories. To discuss the numbers further, we are joined by Anil Rai Gupta, Chairman, Managing Director at Havells India. Mr. Gupta, thank you very much for spending time for us. Do appreciate it. If you can start by telling us how's demand? I mean, what went so good for Lloyd's as well as for the cables business?
I think as far as cables business is concerned, we do see some uptick in demand, also because of the fact that the new capacity at Tumkur has already come up, and which augurs well for the underground cable business. The wires business continues to be strong, but there is a little bit of a concern on the volume growth. Value growth has been good. As far as Lloyd is concerned, it is coming out after a very strong summer last year. So there was anticipation of a very strong summer in this quarter as well. So I would say part of it is also not necessarily completely secondary sales, but also more primary sales. In fact, in the month of March, I would say that it could have been even better had the secondary sales come out much better. But we are seeing a delayed summer, and let's see how the first quarter pans out.
Well, in a way, we are thankful for the delayed summer, if it indeed is. But Mr. Gupta, just let me complete a digression. There is a lot of talk about these lower BIS standards for some categories of compressors. Is that going to make a big difference for you? Any positive difference for Havells?
I think we are well sorted as far as supply chain is concerned. And we do believe that for the next 1 or 2 years, 3 years, we are well sorted for our supply chain, especially for compressors. Okay. I think the government also sees that there will be a time required for the entire supply chain to get set up in India. And I think between the government and the companies, there is a good understanding of how they want to promote the manufacturing in India.
Okay. Well, let me come to the cables bit as well. You sounded very confident. Can you give us an idea, because you may have some idea of how demand is panning out. And then there is the big challenge, perhaps. Some giants are entering the cables business, the Birla Group, Adani Group. If you have to, look out further a year or two into the area, is this going to become a very tough business?
Well, I think, first of all, if we take out the noise of the quarter on quarter, because this depends a lot on the fluctuation in the raw material prices also. But structurally, we are very hopeful of the cables and wires business. One, the residential demand over a period of time will continue to grow. Secondly, the capex cycle and the infrastructure cycle in India for the next few years will remain strong, and hence we are hopeful that the demand will be strong. Thirdly, what is happening is also the global markets are also opening up for cables and wires business, which augurs well for additional capacities to come up. I would say, you talked about the newer competition coming in. This industry is a very large part of the electrical industry, and I think it is still has fairly good share of the unorganized and the non-branded sector. So newer brands, better quality brands, hopefully, should actually consolidate market shares from the unorganized sector. So overall, I think it might not be a bad thing for the industry.
Okay. No, it's just that the competition that's coming are people who have allied products. If you come with cement and with paints, you're somehow approaching the builder or the building industry in a consolidated fashion. Will that pose a challenge?
Well, I think, all companies have their own strengths, and this is also a very positive strength for Havells, that within the electrical sector, we have a composite product range for the consumer. I think, companies will have their own strengths, but also, the distribution channel will take its own time to develop. And I think that's something which, which is a sort of a moat which companies in the incumbents have already created, and will take its own time.
No, I take your point. Brand loyalty is a moat in its own right. But if you can both zoom in and zoom out and tell us about how demand was, your electrical, for consumer durables, basically. Electrical consumer durables has grown 10%, but Lloyd's has grown 40%. More broadly, if you can tell us rural, urban, premium, not so premium, how is demand looking?
I think this was one quarter where we actually saw growth coming back in the rural and semi-urban sector as well. The urban had been doing better in the first half of the year. The rural was impacted. It's coming back. Maybe some impact of the budget changes as well as the RBI relaxations. Hopefully that should augur well for the coming times. I think if we see overall, there is a movement more towards the premium, and maybe that is also a strategy of the company. But that is there we see a movement more towards the premium products as well. If you take fans, it is more towards energy saving products. If you take switchgear segment, it is more towards automation and electronics. So there is a movement towards premium segment overall. And it's not just in the metro towns. In fact, we see that movement in the rural areas as well as the semi-urban areas.
Okay, that's good. That'll be good for margins, I assume. Speaking of margins, what we get from economists and those who are looking at all the tariff and such things is that there will be a disinflation in Asia, in commodities in particular. In the light of that, how are you seeing your margins? Are they likely to better this already decent performance this year?
Well, again, I think there is so much of fluctuation and there's so much of talk about, this whole thing, how things will pan out. I don't think anybody has a full view of this. And this is how, companies like us will have to just play as it comes along. And, a deflationary trend in terms of commodities is always beneficial. Again, as I said, if you take the noise out of the quarter, but at least for a longer period of time, it augurs well for both for the consumer as well as for the company.
Okay. Just to go back to your demand reply, you said that you're seeing rural come back, rural and semi-urban. How is urban? There were a lot of FMCG companies who were shocked by urban stagnation, but that was FMCG. How is it with you?
I think overall we are seeing a good traction in the urban segment as well. This also is reflective of the overall residential growth, residential construction growth, which is happening in India, which actually, because the prices of real estate have gone up so much, I'm just a little bit skeptical about the future. But at least right now, it is showing decent traction.
Okay. Well, just finally, you all swallowed Lloyd's quite some time back, and now it's throwing money for you. What will your next big project be?
I think there are too many projects within our various businesses, and we'll continue to invest. As you've seen last year, we've invested about 750 crores in the capex. This year also, in the next couple of years, we're looking at another 2,000 crores overall, plus an investment of in the renewable space of 600 crores. So there is enough that we have to focus on for growth coming in various businesses. So I think, Lloyd itself is a growth engine for Havells, and those investments will continue in Lloyd as well.
Okay. So largely organic, you think? We shouldn't be expecting inorganic moves, is it?
We do believe that there is enough opportunity in organic to grow.
Okay. We'll leave it at that, Mr. Gupta. It was a pleasure speaking with you. All the very best for the year ahead, and thank you very much for spending time for us.
Thank you.
Okay, so that's Havells. It's a little bit in the red today, but just remember, over the last 2 weeks, that stock rose from less than 1,500 to almost 1,700 rupees. So perhaps a little bit of buy the rumor and sell the news is happening at this point in time. The market itself is perhaps giving back a little of its gains in the banking space again, where there was a lot of buying, but otherwise still holding up quite brightly in the green. Wrap up on Bazaar on that note. Chartbusters coming.